Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities on both the technical side and the fundamental side. Whilst I'll just let you have a quick look at the disclaimer. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. We'll look at the current themes driving markets at the moment. And to kick off the webinar, I'll just run through some of the key ideas and areas that we will look at for this week. We'll follow the usual format actually, so we'll just see where markets are shaping up. Currently, middle of the week, we'll look at one of the themes currently that we're looking at the moment, which is to do with volatility, and just a couple of thoughts around that. We'll then look at equities, so the US main indices, so the S&P 500, the NASDAQ, and then we'll go into a quick review of last week's main event, the non-farm payrolls report, as well as looking at Eurozone inflation, key drivers for both the Euro-dollar and of course the dollar, the DXY index. So we'll look at both those before then also looking at the RBA meeting. Interesting meeting, surprise, rate hike 25 basis points to 4.1%, and potentially a precursor to today's Bank of Canada meeting, which is in a few hours. So we'll look at both the RBA and the implications for the Bank of Canada, and also then a bit more detail around the Bank of Canada's decision, as well as looking at dollar CAD. That should probably take around 30-40 minutes or so. So hopefully that'll set you up with some interesting points and areas that we're looking at currently. Of course, at the moment, stocks doing very well in the US. Really, the main news this week's probably just been something slightly different to do with the oil markets. Saudi Arabia announcing a 1 million barrels per day production cut from July, and all other OPEC plus producers agreed to extend earlier cuts through to the end of 2024. Interestingly, for oil, actually, they were up, oil markets up 2 to 3% after the announcement, but they've really turned lower over the last couple of days. Actually, the announcement was over the weekend. Otherwise, more recently then, equity markets trading largely sideways yesterday. Bond markets, slightly more volatility, but not a great deal. We saw a rise in US yields, which was really tamed later on in the session. And then Asian markets today, fairly upbeat actually, although China reported a larger than expected drop in exports in May. The dollar really has kind of maintained its bullish move from Friday's non-farm payroll report. Those kind of track sideways mainly this week, but it's keeping those gains that it did make on Friday, hovering just above 104, and we'll look at the DXY shortly. I wanted to first look actually at the VIX index. So I mentioned this in our brief summary of what we were going to look at this week, and if you just bear with me, I will bring up the VIX index, which is shortly going to be found here. We've looked at this over the last sort of every now and then we look at it when it's at an interesting point. The CBOE VIX is what we're looking at here, which is essentially a measure of volatility. It's often referred to as Wall Street's fear gauge, and volatility, that's essentially how fast prices change. And it closed below 14 actually yesterday, its lowest close since before the pandemic in February 2020. If we just go back, you can see we have to go back to here. So before the pandemic in February 2020, the lowest close we had yesterday. So the index it's a real-time index which kind of represents market expectations for volatility over the next 30 days, in the S&P 500. And it's derived from actually prices of S&P 500 index options with near-term expiration dates. Essentially, then, it's a way to gauge market sentiment. And if we look at it actually on this weekly basis, we can see the VIX collapsed by 19% last week, and that was the biggest drop of the year. And this came obviously after the debt ceiling deal, and also obviously that mixed kind of bumper headline number, but mixed generally payrolls data, and that sort of diluted the odds of a Fed rate hike next week. The index is actually now over 34% above. It's now 34% below the widely watched 200-day moving average. That's that thick black line here. And we're now actually probably after yesterday's drop, slightly lower actually. So probably, 35% or so below the 200-day moving average. That kind of divergence typically marks a trough in this gauge, and then we would see potentially a burst of volatility. And it's also interesting actually that seasonality also favors a push higher, as the VIX has moved north 80% of the time in June over the past 10 years. So just really interesting, we think this measure of volatility, where we are currently now, very low, and potentially we get a turnaround in that, which means a turnaround in market sentiment, which would probably mean lower stocks and possibly a bid to safe haven currencies. Other measures of volatility, just to highlight actually, so both traded and realized volatility in the Eurodollar are dipping back to pre-Ukraine invasion levels from February 2022. And then despite tight liquidity conditions, FX markets really that taking their cue from bond markets actually. So measures like the MOVE index in bond markets, so that's kind of the equivalent to the VIX in stocks, that is has fallen to the lowest levels of the year. So again, just something to take note of. Possibly we're missing a catalyst for some volatility, but markets really very calm, very sort of lulling us, if you like, into a sense of possible insecurity, just something to take note of. It's interesting if you just think of the wider picture, then the Fed obviously maybe they're not going to do a lot with the policy rate over the coming months, so that's why we have low volatility, even allowing for potential shift in July as opposed to June next week. One other area to point out is again stock market breadth. We've highlighted this over the last few months really. It remains weak with only about 40% of the S&P 500 index constituents trading above their 200-day moving average. Concentration, this is key really, has increased too, as basically the 5 largest companies now make up a quarter of the S&P 500. So as we've said before, this year's gains primarily driven by tech mega caps. If you think the S&P 500 up about 12% over the year, but that if you equally weight the index, it's up only 1.5%. Also then, with earnings estimates for the next 12 months, they continue to be revised up, indicating the stock markets aren't really concerned about a recession. And this is in contrast to, of course, some leading Wall Street economists, especially say from investment banks like Morgan Stanley. And then the curve inversion that we still have in bond markets, which generally points to recession. It doesn't give you the timing, but does point to recession in sort of 18 months or so, and we've been seeing that over the past 12 or 18 months. So interesting divergence between sort of what stocks are saying, earnings revisions, and then also this lull, this very quiet, calm period in some of the measures of volatility. Otherwise, if we look at stocks generally, Let me just pull up the S&P 500 so you can see that. That is here, and I'll just pull up the weekly chart first of all. Yeah, S&P 500. Well, yesterday closed higher. Stocks really, gains limited, light volume really, lack of top tier data. The benchmark closed up the S&P 500 0.24%, but it settled actually at its highest close this year, and you can see that just about there. We have to go back to sort of mid-August last year for a higher close, it looks like. A lot of well, if we look at the other indices, Nasdaq added 0.36%. The Dow lagged, actually finishing just 0.03% higher. Interesting when I talk about breadth, though, the Russell 2000, so that's a small cap index in the US, that outperformed quite strongly. Gains led by regional banks, and it kind of follows on from a bullish outlook on the US economy by Goldman Sachs. They cut their probability of a US recession within the next 12 months to 25% from 35%. They also forecast US GDP growth of 1.8% this year, so surpassing Fed forecasts and most other investment bank estimates. So just in contrast to what I've been saying, but just a really interesting sort of divergence in views, we think, which always makes for volatility at some point. Friday, if we just go back to non-farm payroll day, of course, US stocks cheered that latest jobs report. Really, S&P recorded its biggest one-day rise since April, and actually marked its third straight week of gains, 1.8% increase there, and you can see that on the chart. If we just look at the chart now in more detail, the technicals, then we can see this weekly S&P 500 chart. We've highlighted actually this late January level 4195 being a key level of resistance. Everybody was looking at that sort of 4200 resistance zone, coupled with that light gray line, which is the 100 week moving average. That's at 4200 or just there or thereabouts. And you can see we sort of tapped that level a few times and then broke it after that strong close late a couple of weeks ago. We dipped down below sort of 4100 and then up and closed near the 4200 level, just below, I think, the close. Well, 4205 actually, sorry. And then last week sort of dipped around there, traded around there before then closing really strongly, very close to its highs of 4290, closed at 4282, and then this week we're just sort of oscillating around those highs, interestingly, so keeping the gains, but a much narrower range of trading. If we can see that on the daily, you can see the push above that 4195 level, sort of oscillating around there, and then the big push higher post non-farm payrolls, and then was just sort of tracking sideways, but keeping those gains. So 4200 becomes now a big level of support, obviously, and then if we can break that recent high on Monday, 4299, then potentially we look towards probably that mid-August high from last year at 4325. That would be the next level for us, with 4200, as we say, very, very strong level of support. If we just look at the Nasdaq as well, so this is the Nasdaq 100. Again, on the weekly, we like this chart, sort of hovering around the lows, the highs, and then a sharp break higher after sort of consolidating those recent highs. That 100-week moving average again at sort of 13,430 or so, and then we broke above that, and then the target was that mid-August high at 13,720, and then a strong push higher again. So you can see consecutive weeks of gains, very strong bullish momentum really after breaking above there, and now we're sort of tracking sideways after pushing up to a recent high again at 14,662. So really for us, we would look at 15,000 being a key level then, the next key upside level, And if we just look at the daily, you can see, yeah, just tracking sideways at the moment. Unsurprising after so many consecutive weeks of gains. Near-term high 14,662 is a key level, probably for more upside. Otherwise, we've probably got a fib level, actually, you can see there, long-term fib level around sort of 14,349, potentially acting as support if we do track sideways, potentially roll over slightly. So that's the Nasdaq. We'll also look at the Dow. Obviously, less gains in this index. We've said most of the gains in the stock markets, US stock markets, have been driven by the mega cap tech names. None of those in the Dow, so struggling with gains, but still pushing slightly higher. Not this week, but certainly last week after the non-farm payroll report. So you can see on the weekly chart for the Dow, we sort of held quite nice support around the 50-week moving average at 32,728. You can see there, tapped it a couple of times over the last couple of weeks and then bounced. And then on the daily, you can see, well, if we just pull it back, you can see this push higher on non-farm payroll, so above the 50-day moving average at 33,430, and the 100-day moving average at 33,332. We've got this big level of resistance for us, tapped it a number of times over the last few months, this year really, 34,281. Around that level is strong resistance to any upside move. And then below, probably those near-term moving averages, we do have the thick black line, which is the 200-day moving average at 32,757. You can see there capped downside and acted as quite decent support over the last few days. So that is a key downside level for us in the Dow. Okay, just firstly then, let's go to a recap of some of the main risk events. Firstly, we had non-farm payrolls from Friday. Always important for us to review these key events just to see where we are, the landscape in the US economy. Of course, another blowout headline number, 339,000 jobs in May added, well above the sort of 195 consensus expectation, and even the top of the range, that was around 250, I think. Upward revisions, as you can see on this graphic, over the last 2 months, total 93,000, really underscoring the strength of job creation. But there is a caveat. The employment payrolls increase was at odds, really, with a significant increase in the unemployment rate. That went from 3.4%, which is admittedly a multi-decade low, but jumped up to 3.7%. Despite a stable participation rate, because then the latter is derived from a separate household survey, which pointed at 310,000 net job loss in May, while the number of Americans actually classifying themselves as unemployed rose to 440,000. So there's a kind of clear divergence between the two surveys, which the sort of whole unemployment and employment data of this monthly report gets its numbers from. The jobless rate is calculated from the American Household Survey, whereas payrolls, the headline number, is calculated from employers' surveys. So it's kind of who to believe, as they both indicated kind of very different messages about the direction of the US labor market in May. Certainly, we also got softer wage growth, which is encouraging for the Fed. That figure printed down from 0.5% to 0.3% here month on month, and also hours worked edged lower as well. So interesting then, sort of moves from the payrolls data in total. Obviously, we got that decent move up in stocks. And if we just look at then the CME Fed Watch tool, so that gives us basically Fed funds futures, an idea from those markets as to what is priced for the next few, well, every Fed meeting, FOMC meeting. You can see here, 14th of June, we have the pricing. And after the non-farm payroll report, of course, we were coming off the back of kind of more dovish repositioning after some of the Fed comments kind of pulled the plug. Fed Vice Chair Jefferson and voting Fed member Harker kind of pulled the plug on a June rate hike. And we're now sort of most likely to skip the June meeting next week for any more rate hikes. And you can see here, we have the chances of a 25 basis point hike, 25%, 75% pretty much that we stay unchanged. And if you just bear with me. Yeah, sorry, just checking where we have been recently. So, yeah, we were sort of, yeah, we have been much higher than the 25%, sort of 40% or so over the last week or so, last weeks, but then a few Fed officials causing this dovish repositioning. But then if we look at July meeting, so that's the 26th of July Fed meeting, you could see then, yeah, much bigger chance of a 25 basis point hike. 52% chance, and then if you add in the sort of 14% or so, then it's sort of 66% chance that we do get a rate hike in July. And 34% chance then that we stand pat. And interesting really that if you look at sort of previously, then even a month ago was sort of around the 60% mark that we stay at 5% to 5.25% at the July meeting, but now sort of more of a chance then that we get a hike. And again, you can see the difference, 52% now for a hike, a 25 basis point hike in July. That was just 5% a month ago. Okay, that's really the US side of things. We did have, interestingly, ISM services data out on Monday, which was disappointing. Up until that released, post-payrolls momentum really pushed rates, as I said, and the dollar gently higher. But afterwards, kind of intraday fortunes changed. That ISM data fell from 51.9 to 50.3, so holding just north of that sort of 50 boom bust area, that level, which denotes sort of expansion and contraction. With the exception of December 2022 is actually the weakest reading since May 2020. And kind of undershooting that consensus estimate of 52.4 as well. The internals were weak, so slower growth in new orders and business activity. And interestingly and importantly, lower prices paid. A lot of emphasis on that number for inflation. That dropped to a 3-year low and kind of extended the disinflationary trend, so falling prices trend that we've seen recently. Went from 59.6, which was elevated, down to 56.2 in April. Really interesting then for us then, this kind of deteriorating services sentiment potentially, really something to keep a close eye on, because you have to remember this sector has kept global economies humming along, ticking along quite nicely over the past few months. So if we do get another few readings, another few months of this ISM services data falling, then that will be significant for the economy going forward. We do get initial jobless claims out on Thursday. That's a weekly number, of course, likely to remain sub 250,000, but expected to rise ahead as more industries are announcing layoffs given the uncertain economic outlook. Okay, if we just check on the DXY chart, just bear with me while I pull that up, which is obviously the dollar index, tracks the dollar index against 6 of its major trading partners, the euro being the highest weighting in this index, of course, around 56-57% or so. For the dollar, well, DXY, you can see If we look on the weekly chart, sort of base around 101.33, which was the low from January. You can see we sort of traded around that level above it mainly, and then sort of built the base, especially as we broke that long-term trend line resistance back in early May, and then we've had a few consecutive weeks of gains, and then we're just tracking just around those recent highs around and above 104, and you can see that more clearly on the daily chart. So the break of that long-term trend line resistance, if you like, and then moving above a few long-term moving averages, the 50-day and the 100-day moving average. That's now at 102.96, so just below 103. So sort of near-term support, probably the recent lows are 103.38, and then the near-term highs at 104.69, so kind of tracked in the middle of that range, and needing a catalyst really to break higher or lower. And we can't obviously forget that next week we have a blockbuster week really of risk events. We have US CPI on Tuesday the 13th, then the Fed meeting not long after the next day, the 14th. Then a few hours later, 18 hours or so, ECB meeting on the 15th next week, and then the BOJ meeting on a Friday morning UK time, the 16th. So huge risk events coming up, and it will certainly, you would think, break this sort of tracking sideways range trading, break out of this potentially. Okay, otherwise, let's just look then also at Eurozone CPI, which is always important number for the ECB. Just bear with me, I'll just pull up a chart of inflation. This maps actually, you can see Eurozone inflation against US and UK. So Eurozone is the middle line, the blue line, which is falling, of course, but slightly lagging that US fall, whereas, of course, the UK has a kind of issue with very sticky, elevated inflation. As for the Eurozone print, well, that was released, as I say, last week, confirmed kind of disinflationary prints from the country releases that we saw before that. So HICP, it is in Eurozone, the inflation came in at 6.1%, sharp drop from 7% in April, sorry. Core inflation, interestingly, also showed more than an anticipated slowing to 5.3% from 5.6% in April. Forecasts were for a 5.5% print. I think there is a sort of one-off factor around sort of the German transport ticket, apparently, economists talking about, which is likely to have been a key reason for the decline in Eurozone inflation. And especially the core, so potentially we shouldn't overinterpret that much. Although a detailed look at the breakdown showed services easing, non-energy industrial goods continuing their decline from the peak reached last year, and food also easing in April. So what does it mean for the ECB? Well, policymakers have been out in force, officials have been out in force, really recently stressing that higher rates are still appropriate and that 2024 rate cut bets will likely have to be adjusted potentially. Interestingly, ECB's President Lagarde spoke just after the Eurozone inflation release, saying inflation was too high and there is no clear evidence that underlying inflation had peaked actually, and there was more ground to cover to bring interest rates to sufficiently restrictive levels. So pretty clear from President Lagarde. This week, interestingly, we have had some data, sort of second-tier data, but we've had weaker than expected German factory orders in April, and then a softer than forecast Eurozone retail sales in the same month, kind of reflecting potential building headwinds for the Eurozone economy, just to bear in mind, particularly on the industrials side. We also had an ECB report actually across the board, which showed deterioration in its consumer expectation survey for April. The view on inflation, income growth, spending, house growth, all waned, while expectations for economic growth remained in negative territory. So really interesting, sort of clear signs, clear indications of weakening demand potentially in the Euro area, and certainly that has been hurting the euro. And I'll just pull up a chart of euro dollar, just bear with me, which is obviously here. So just moving on to that, potentially, well, firstly, just for the ECB next week, then 25 basis point hike is baked in, fully baked in for that meeting, and also then in the July meeting as well, pretty much, I think. So interestingly, though, the euro hasn't really benefited from or had a sort of underpinning of support from those rate hikes, as markets look further afield really to some of these headwinds in the economy, and some of that data this week I've just highlighted has sort of indicated the way for the economy going forward potentially. Euro dollar, certainly that's taken, euro has taken the brunt of sort of dollar strength as well. If we just look at the weekly and just expand it, we've had sort of 4 consecutive weeks now of losses, kind of opposite to obviously the DXY index, and we're now tracking sort of just above those recent lows at 106.35, narrow range week so far, inside week at the moment. After that doji candle, you can see last week doji candle means kind of indecision, where we close and open near the same level, and in the middle of the high and the low, so in the middle of the range. So that's what we saw last week after 3 strong weeks of losses in the euro, a doji candle, and then sort of inside candle this week, obviously building up to those major risk events next week. You can see the break of that long-term trend line support, also that 50-day moving average, and then the 100-day moving average as well. So we get sort of support, we think, probably for this rally, this year's rally at least. There is support at the 61.8 fib level, 107.16, and we're just tracking around that. But certainly 106.35 key level of support. If we break that, then we're looking down towards sort of 106, and then these levels from March, which is sort of just above 105 potentially. Otherwise, upside break, if we keep the sort of longer term momentum going, then 107.79 is key level for us, and then potentially a next fib level, halfway point of the rally of this year, 107.88. Okay, that's ECB. Just quickly then, let's move on to also the RBA meeting. We had that really interesting, raised policy rates by 25 basis points to 4.1%. Majority of analysts actually expected an unchanged decision, so it was a surprise after the RBA already restarted hiking actually last month. So 2 consecutive meetings of surprise hikes. The RBA had assumed that inflation had passed its peak, or so they do assume it has passed its peak, but at sort of 7%, it's still much too high. Also, recent data indicated that upside risk to inflation outlook have increased. This is all in the RBA statement. And sort of the hike on Tuesday should provide sort of greater confidence that inflation will return to target within a reasonable time frame. Growth in Australia has slowed and conditions on labour market have eased, but they do still remain very tight. And also wage growth has picked up in response to that tight labour market and high inflation. So in this respect, really, the RBA board kind of remains alert to the risk that expectations of ongoing high inflation contribute to larger increases in both prices and wages, especially given the limited spare capacity in the economy and the still very low rate of unemployment. That means the board did conclude that some further tightening of monetary policy may be required, and certainly we had Governor Lowe, actually RBA Governor Lowe, and his Deputy Governor Bullock out on the wires overnight last night, actually helping the Aussie maintain the sort of post-hike momentum, really, even amidst a bout of slight risk aversion and mildly weaker than forecast real GDP metrics we had as well. So for the Aussie, if we just look at technicals on the Aussie versus the dollar, you can see we've highlighted this sort of range trading between sort of 68 and between kind of 66 or so, just below there for the last few months. We broke down then below it, printing a low below 65, 64, 58, you can see there. Sort of middle of last week, this time last week. But then obviously the RBA meeting as well, seen, well, that was Tuesday, of course, giving us a bigger lift. But then the Aussie going back into this range, back above the 50-day moving average and now towards the 200-day moving average, which is at 66.90. So positive, strong, bullish momentum, really, consecutive days of gains. So next upside resistance for us would be the 100-day moving average, which has capped the levels there quite nicely, actually, over the last few months. So watch out for that. That's at 67.44, and then obviously the top of the range around 68. So there they are levels to watch on the upside in the Aussie dollar. But that brings us to the main event of this week, which is the Bank of Canada meeting in a few hours' time. Potentially a similar path to the Bank of Canada, the RBA, and certainly it has raised expectations potentially for a move in the meeting in a couple of hours' time, as I say, towards well, another 25 basis point hike. And just on this graphic here, which I was just pulling up, hopefully these prove of some use to you. You can see potentially, well, there's no consensus says no changes expected. So Bank of Canada would keep rates at 4.5%, but money markets have lifted the chances of a 25 basis point hike to 4.75% from sort of 30%, I think it was, only sort of last week, to around 45% now. So odds sort of slightly higher towards a coin toss, really, after the RBA's surprise move. But certainly they're pricing in a full 25 basis point hike by the September meeting. Interestingly, in the recent months, well, we've had there's been an expectation that Bank of Canada would keep its policy rate unchanged through the rest of this year, and they've obviously kept on hold since the January meeting. But then we've had, and you can see some of this data out recently, stronger than expected GDP, 3.1%. Versus 2.5%, and then CPI metrics as well have been stronger than expected, 0.7% month on month versus 0.4% forecast. We also have a still buoyant, really, housing market, and that's kind of all raised speculation that potentially the Bank of Canada raise rates at this meeting rather than by September. Minutes from its last meeting revealed that officials had discussed raising rates due to concerns about persistent inflation, resilient economic growth, challenges in lowering inflation, and then certainly the risks of delaying action were kind of the main arguments in supporting the case for a rate rise. And the Bank of Canada kind of does expect inflation to ease, but it's very sort of aware that reaching its 2% target may take longer than expected. All that said, the bank has also stated previously monetary policy operates with a long and varied lag. So that means policymakers do expect consumption to moderate through this year as its restrictive monetary policy works through the economy. And so they potentially may want to err on the side of caution while assessing that lagged effect of monetary tightening. Also interesting, really, we think developments in the US may play an important role for the Bank of Canada. If we get these jitters in the US economic outlook, obviously with that ISM services report adding to those fears, potentially then slowing the Fed after this potential pause. Then if we get more weak data, that will potentially have an impact on the Bank of Canada going forward. If we just look at the dollar versus the CAD, one final chart before we leave you. So bear with me 1 second. I'll just pull up dollar CAD, which is here. So we can see, well, Canadian dollar's actually been the second best performer, I think, G10 performer anyway, over the last 30 days, aside from the dollar. But that's certainly thanks to kind of its high correlation, high beta to the US economic narrative that had picked up, of course, with, well, certainly a hike baked in or priced in for potentially July. So we had a repricing in the sort of Canada domestic rate and growth story, and that's kind of overshadowed as well oil's subdued performance in May and sort of risk sentiment as well, sort of instability around the debt ceiling. So crude obviously a key driver, key correlation to Canadian dollar and also risk sentiment as well. Dollar CAD then sort of moved lower, strong move lower at, well, last week. That sort of broke this sort of, well, didn't break, but moved away from the top of the range, sorry, above 135, you can see there, and then through those long-term moving averages. And we're now sort of, we've got a sort of short-term trend line support really, and we're just sort of trading on that now. So potentially if we break that, then we move down towards sort of 133, which is these lows here, which will be an interesting level. I think a hawkish hold is the minimum, is what is expected by markets from the Bank of Canada today. So anything less than that means we will bounce off this support level and potentially then challenge 134.61, those recent highs, and then we get up towards sort of 135, and the confluence really of all of those long-term moving averages which congregate around, yeah, the 135 level. If we do get a hike and then more bullish talk, hawkish talk, then certainly we will break down below that support trend line and move down towards 133. Okay, that is all we have time for today. Hopefully that's proved of use to you guys. No questions I see in the box. So yeah, take care out there. Bank of Canada to look forward to, and then we will speak to you in a couple of weeks on June 21st. So certainly after all those main risk events, which we will review and check out all the price action and what is happening potentially going forward after those big central bank meetings next week. Okay, take care of that, and we'll speak to you in a couple of weeks' time.